Firstly, just like to thank Kenanga Futures as well as the CME Group for inviting me today to speak on this topic entitled US market opportunities and also the outlook going forward. So just to give you a very brief background, I'm pretty much trading the US market for quite some time, especially the futures market per se. Understanding the US market requires a little bit of different insights if you are trading the local market for especially the KLCI or even in fact the palm oil market. Trading US market, especially the foreign market, requires a little bit more different strategies when it comes to finding opportunities. So I think in the next half an hour or so, hopefully I can give you, hopefully you're able to gain some insights, especially on ways and techniques to look at how to actually navigate the US market, whether you're using technical tools or whether just looking at things fundamentally. So hopefully at the end of this webinar session, you're able to gain some of these insights and hopefully pursue that in your trading journey. So just before I start, just as usual, risk disclaimer. I think the materials presented here are purely based on educational purpose. It doesn't constitute any recommendation of buying and selling. And also, I think my views that's reflected here in this webinar is purely based on my own. It doesn't reflect opinions by either by CME Group or even by Kenanga Futures. So it's purely based on my personal opinion. And also, I think dabbling in futures market requires a lot of exposure. Is a highly risky instrument. So make sure that you are well educated. Seek more resources. And I believe Kenanga Futures in certain ways can help you with that regard. So this agenda for the next hour or so, I think firstly is that, especially looking at the US market, probably I've noticed that, the indices pretty much, whether they're talking about S&P 500, the mini Dow or even the Nasdaq market, both of these indices market has actually recorded tremendous rally. Unfortunately, we don't see that much in our local market, but I think US market continue to prove skeptics wrong. And I think those rally that we're seeing right now is probably might continue by its own, is probably going to have a lot of resistance along the way. I think the second part is that, when we talk about US market in particular, there's a lot of narrative that says that, is US market really in a recession? Because if you just look at certain statistics or certain economic numbers, actually they're pointing to you that that's the narrative that the market is actually heading. But I think later on in the first part of this webinar, hopefully I can share with you certain insights or certain key indicators as both to look at, especially when you're looking at economic performance. I think to a certain extent, it does show that US is showing a bit of weakness. But in totality, I think if you compare with other markets, I think US is still pretty much stable in that regard. So I think therefore market is factoring that. And you just look at US market itself, is still continue to show quite a strong rally across the board. Now, I think if you're in the market, last year we talked about inflation. I think 2022 is pretty much the year of inflation. We have seen commodity prices hitting all-time highs. You just look closer to home, like CPO market, we hit as high as almost close to 8,000 ringgit per ton, the prices that we've never seen before. So all these are actually feeling inflation effect. So obviously, I think inflation is not something that is very friendly to central banks across the world. I think US Federal Reserve will continue to look at rate hikes as a way to tame inflation. I think in certain ways they are quite successful in that. But I think it's worth looking at rate hikes and inflation because that ultimately will affect markets. And as a trader, if you are trading the US indices market, trading during those key economic release numbers days, or even in fact Federal Reserve FOMC meeting, usually it can be quite volatile. So again, I think it's cautioned against for those who are new to the market. If you are seeking for excitement, you trade for those, especially the economic releases days. If you want to avoid those spikes, it's best for you to avoid those release days or even FOMC meeting because I think I think market nows are very sensitive to rate hikes announcement. So I think that's going to have an impact on the market overall. So if you are thinking to not to be too exposed to huge price fluctuation, I think avoiding those FOMC meeting days is a good idea. Last but not least, I think in the second part of the webinar, you'll be covering on some simple trading plan strategy that you can use to execute, especially when looking at CME Micro Indices. Keep in mind, CME just probably about 2 years now, they just launched a micro contracts. It's a very small contract. It is easily accessible. So if you are gone are those days where if you want to trade the US market, the number one obstacle for us is that because it's denominated in US dollar, it's actually kind of expensive. But I think with the introduction of micro contracts, it's actually making it easier for trader to actually gain exposure in these type of markets. So it's both to take a look. I'm just going to share a little bit on a contract specification, so that you're able to understand better what CME micro indices contracts are. So just going to share with you the indices performance, especially in the US market. So there are three major indices we are comparing between the S&P 500, the Nasdaq market, and also the Dow market. So you can clearly see that back in 2020 during the height of the COVID-19 pandemic, markets is actually it was actually falling about close to 30% on average. But since then it recovered tremendously. In fact, we're actually hitting all-time high. And I think we hit an all-time high back in early part of 2022. But since then, I think that there's a bit of sluggishness in the market because given that inflation is a major concern last year. So a lot of central banks actually hike interest rate in a quite massive manner. So that actually caused sentiment to be quite wary, especially when it comes to equities market. But I think that has taken a turn. First half of this year, we see strength across all markets. I think eventually, if you just look at US itself, we are seeing recovery across the board. So I think it's interesting to watch in the next couple of months or so is whether can this rally continue to hit all-time high, or the market will eventually be exhausted and the rally might turn into a possible downtrend rally. So I think that's where we really need to be careful of, especially as stepping into the second half of this year. Now, if you compare the different US indices, we can clearly see that Nasdaq is the one that's performing very well. Nasdaq are basically is a stock index that comprises a lot of your IT companies, and I think you can clearly see that technology companies was pretty much a theme for pretty much the pandemic era. So clearly, I think Nasdaq has clearly outperformed S&P and even the Russell. In a lot of benchmark, especially when you look at US markets, because there's so many benchmarks to look at and assess. A lot of people will use Russell index as a way to gauge the overall economy of the US market. Given the fact that Russell comprises almost 2,000 listed companies in this index, especially the Russell 2000. So, in a way, it's actually a very good barometer when it comes to looking at whether US continue to perform well. So a lot of people tend to use Russell as a major comparison. But having said that, if you just compare with like Nasdaq, clearly they've outperformed given the fact that a lot of IT companies or even technology companies has actually recorded tremendous valuation. Given that it's a theme now, everyone is thinking that this industry is much to talk, and everybody is investing in it. So you can clearly see Nasdaq is the one that's performing well. Now S&P is very balanced. Is representation of technology companies are quite balanced. But keep in mind, you have your Meta, you have your your big seven, which is Meta, comprises Meta, Amazon, and pretty much of some of the big tech companies. They constitute quite a big percentage in majority of these indices. So in other words, if you really want to track the index performance, you can technically or indirectly track the performance of these top 7 companies. So as long as these top 7 companies is still going to continue to record rally in their respective price performance, I think that will also push the index higher. So this is something for us to take note. If our trading index market, it's also good for us to draw comparison and trade to look at individual stocks performance as well, because ultimately they will carry the weight in the index as well. Now, just going to compare, when we talk about index performance, it's also good for us to draw a comparison with volatility. I know you understand back in the height of COVID-19 pandemic, we saw volatility increase tremendously because of the uncertainty that's in the market. So volatility is represented by VIX index, which is also known as a fear indicator. So when VIX index goes to tremendous level, that shows you there's a lot of fear in the market. We have seen that back in early 2020. That's where the market, the stock market, especially the S&P 500, actually plummeted to close to 30 to 35% level. Now, obviously, you have seen past that with the invention of vaccine, and I think the pandemic is pretty much behind us now. So you can clearly see that the fear has no longer been there. The market continue to post rally. What's interesting is that VIX now is pretty much at a very low level. I think it's also close to almost single digit. So what this tells you is that when you see this type of market, historically speaking, it's telling you that the market is very complacent. There's no pretty much there is a non-existence of a fear in the market. Now, this can be it can be a double angle to look at it. When you have less fear in the market, eventually something could trigger a panic in the market. Eventually, the VIX will spike up. Now, when you have a low VIX index or low VIX figure, it tells you that the market, the rally they are seeing right now, it seems to be quite unperturbed and looks like it can continue to rally. So as long as VIX is still pretty remain very low, it tells you the room of rally is still there. But keep in mind, anything could trigger the market panic, whether it's geopolitics, whether it's any other factors. So as a trader, we really have to pay attention, slightly a bit more attention on VIX index, pretty much as a barometer of fear. Currently, there's not much fear. We are seeing not much fear in the market, but eventually, something of a hair trigger could really trigger panic across the market. Now, this is also another interesting development now. I think the circumstances right now is pointing to you that actually pretty much everyone is full onto the equities market. There's, even you look at it, this is what we call a put call ratio. So normally in this ratio is basically we are computing what is the total percentage of put options against the call options. Now, just to give you a very brief simplistic explanation on the options market, put options are related to when markets are falling or when markets are witnessing a downtrend market. A lot of people will jump into the puts market, put options. Now, if the market is very bullish, it's a very risk-on market, normally people will go into the call options market. So you can clearly see when you look at the ratio, if you just take the ratio between put and call, you can clearly see that right now people are trading more call options rather than put. So the ratio is actually pretty low. Again, this indicates that the market is pretty much risk on, and everyone is just jumping on the bandwagon that the market will continue to rally, and therefore they are purchasing more call options rather than put options. Now, this is again, you can look at it at double angle. Keep in mind, when everybody is too concentrated on one side of the market, and if there's any slight correction in the market, it will trigger a massive rally on the reverse. So if everybody's on the call options, when this call option starts to, or markets start to suddenly take a turn, these call options will be exercise worthless, and everybody will be jumping on the put options. So again, I think these are all the dynamics that we need to understand and really look at the market right now. And indirectly, if what this tells you is that when you have a low put and call ratio, if you have a portfolio of stocks, it's now the cheapest time to be using put options to cover your or to hedge against your portfolio, because I think the premiums that you pay for put is actually very low because no one wants to buy put. So therefore, the premium for put options are actually pretty low. So I think that's another observation that's worth looking at. Is this telling you that the market is actually very risk on, and they don't see much fear in the market for now? Now, I think that's also attributed by growth numbers. You just look at what WEO has mentioned, or even IMF. I think they're projecting that second half of this year, it looks like it's going to be a better year. We are looking at next year is slightly going to be a bit tricky. Things are not looking that fairly bright. Certain areas, I think the prospects may remain quite cloudy. So I think that's where we are at the moment. So as long as growth are still being projected, especially for big major economies like US and Europe area, I think that will probably lift up the sentiment for the market. The only key thing is that China remains very techy, given the fact that China show a bit of weakness and is quite sluggish when it comes to their numbers. So it's actually remain much to be seen whether China can continue to perform well going forward. Again, I think overall what this tells you is that global economy seems to be on a strong footing. and looks like it can continue for the next couple of months or so. Next year, 2024 is going to be a bit tricky because there's a lot of resistance and headwinds that's approaching. Whether it's monetary policies or whether it's geopolitical tension, I think all these will weigh in as factors that can actually trigger market panic. So it's something for us as a trader we have to be careful of as well. Now, just sharing you inflation numbers. I think just looking at it, inflation seems to be no longer an issue. Last year, I think everyone panicked, especially, with the Ukraine and Russia conflict. It actually aggravated the inflation number. But then again, since then, I think, supply logistics has started to come back. Logistics has no longer been an issue. Countries are opening up. So inflation starts to ease. When that happens, I think usually that's a good news because, I think sooner or later central banks may take a slightly softer stance when it comes to inflation. They no need to hike as much as they are like last year. They can start to slow down, and when that happens, usually, you see lower interest rate, and that will pretty much prime up the economy. But given the fact, I think inflation, we have to acknowledge, despite we are seeing lower numbers, those numbers, if you compare to before the COVID-19 pandemic, is still pretty much relatively very high. And inflations are very sticky, especially when it comes to food inflation. You don't see quarter to quarter changes when it comes to your food prices. You talk about other big items, they may reflect quite immediate, but not in terms of food prices. So that's where we really need to be careful when it comes to inflation. Also keep in mind, we have the Ukraine and Russia conflict that's still going on. And these two are pretty much a commodity superpower. So when it comes to when both of them are fighting each other, it's definitely going to affect commodity prices. And if its commodity price remains high, that would definitely be something to watch out, and probably going to be putting inflation on quite a stubborn burner. Now, just to share with you, I think this is what's happening right now. So again, you look at it, 2022 was a year of rapid inflation. Those commodity that we are seeing is most of the commodities actually record high prices. Whether you talk about palm oil, whether you talk about soybean oil, soybean, corn, majority of these grains market actually recorded tremendous rally last year. And it doesn't help with the Ukraine and Russia conflict. Now, this year, things are starting to normalize. But then again, the levels are still much higher compared to 2021 and 2020. So this again tells you that despite you are seeing lower inflation numbers, but those levels are still remain very high. And I think, again, if any geopolitical tension between Ukraine and Russia starts to get worse, I think commodity prices is the one that's going to be affected. So, eventually it's a balancing act, which is a very, very fine balance that you need to practice. So it's very difficult. Again, I still think that inflation is probably going to be a medium-term concern. It's not something that we can wrap it off in just a couple of quarters, but it's really going to be quite persistent. And geopolitical tension is not a beneficial for when it comes to issues like this. Now, so inflation aside, if you just look at other economic indicators, especially when it comes to job numbers, I think US economy does show strong figure around this area. If you just look at US job openings, although they have slightly came down from the peak of last year, after the US economy reopened amid the pandemic, we still see those numbers start to come down. But if you compare to where before the pandemic levels, the levels are way much higher. So what this tells you is that despite we're seeing slower job openings, but the levels are still pretty decent. So in other words, the economy is still growing. And as long as there's job openings and there's employment to be filled, unemployment will continue to come down. Now, when it comes to jobless claims, it's interesting. I think if I recall correctly, last 2 months figures was actually quite a surprise when jobless claims came down quite substantially. So that tells you that the US job market is actually quite tight. So when job markets are good, that tells you the economy is actually still growing on a healthy trend. Now, besides job numbers, if you just look at other indicators like new orders by manufacturing or producers, you can clearly see those numbers are also rebounding. That tells you that companies now are actually going into, especially manufacturers, they're buying new orders, they're buying more for the next few quarters. So that shows you a healthy sign. when it comes to consumer confidence as well, I think consumer right now is still quite confident in terms of the economy, and therefore they'll probably be spending more. Keep in mind, US as an economy is very reliant on personal consumption. In fact, I think if you just look at the breakdown, consumer consumption is pretty much 70% of its total economy. So that's a very huge, percentage. So whenever the consumer feel that they are confident in the economy, they would tend to spend. So therefore, that will actually be a support growth for the economy. Now, other than that, I think when it comes to business environment and consumer as well, actually both this index shows you a very strong positive growth. In fact, I think businesses are still quite positive in its own economy. So these are telling you that despite interest rates are high, rising interest rates, inflation is very stubborn and persistent. Businesses are still spending. And pretty much they are still powering the economy. I think this is something that for us to take note of and really watch out for the next few quarters, because if any sign of weaknesses, especially when it comes to business investments or confidence, that's where we really need to take note of. Now, given the fact that US economy, certain numbers are showing you very strong positive and strong optimism, I think therefore a market will persist that will pursue further optimism in the market. And I think if you just look at it, where stock performance is as compared to bond, you can really see there's a shift on sentiment. A lot of people is actually jumping into the equities market rather than the bond market. That shows you how confident they are when it comes to whether it's talk about company earnings or or the economy going in the next 6 months or so. They're still quite confident in it. Now, the key parts is that despite the rally they're seeing in the overall US index market, if you just break it down to certain sectors or sectoral basis, there is a slightly different picture. Now, if you just look at it, consumer discretionary, communication, industrials, or even real estate, these are the 4 major sectors that should respond very well, especially during an economy recovery. Now, energy is the one that's not benefiting. Keep in mind, despite strong oil performance, there's a lot of capex that's some of these large companies they are involved in. So therefore, despite we're seeing strong crude oil prices, that doesn't mean they will translate into high profit. So then eventually energy and materials, these are the segments that still weigh in on the market itself. But nevertheless, if you just look at investor sentiment, and if you look at the investment sentiment survey, you can clearly see that pretty much everyone is quite optimistic with the market. Now, when you see these numbers, it's actually quite foretelling, especially when you see high numbers. Normally, when you see high optimistic numbers from investor sentiment, pretty much it tells you if the rally in the market, probably it might be exhausted quite soon. So that's where you also need to be careful and balanced with. Numbers right now is showing you that those numbers are improving. It shows you people are getting more confident in the market. But eventually, when the investment survey reach to as high as 60% optimism, I think that's where we really need to be careful. Normally, that foretells you that market will pretty much change their view, and the rally that we're seeing in the market will probably be exhausted. So that's where it's important to take note if you're looking at investment survey, because that's usually be something of a sentiment that's in the market. Now, so going back into looking into individual stocks, you can clearly see, I think, whether comparing Meta or Amazon or even Google or Tesla or Apple, as a matter of fact, I think you look at where the price performance of each of these individual stocks, you can clearly see they're performing very well. But of late, we're seeing a bit of weakness. So to gauge where the market or where the index is going to perform, we really need to see how these 5 individual companies are going to do. Because keep in mind, these 5 individual companies pretty much comprises almost 20 to 30% of your market indexes. So in other words, they carry a heavy weight when it comes to, or carry a heavy weightage when it comes to your US indices. So eventually, if these companies don't perform that well, or earnings are below expectations of the market, I think that's where rally that we're seeing in the market probably be facing a bit of resistance. So, if you are trading the index market, have a look at the individual stocks, because that will probably be painting to you a slight picture of where probably the index is going to hit in the foreseeable future. Now, when we look at back in the earlier couple of slides, you notice that when you look at Nasdaq or S&P 500, even in fact Dow Jones market, you notice that they actually move quite parallel. Keep in mind, they are all different indices representing different type of sectors and weightage. Now, there's also a period where, especially you look at Nasdaq comparing with the S&P 500, there's a period what we call divergence. Divergence meaning in the sense that, when Nasdaq market goes up, the S&P 500 doesn't follow. And this happens a lot, quite frequently when you take Nasdaq market comparing other US indices like the S&P 500. Keep in mind, Nasdaq are very IT and technology oriented, and during the pandemic era, technology companies are pretty much in favor because of the theme and the narrative. So now, when you see divergence like this, it's interesting in the sense that if you follow on the historical relationship whereby Nasdaq will continue to perform quite parallel to S&P 500, this is where the moments you get caught, and that's where, as a trader, we need to be very sensitive. Nasdaq right now is pretty much outperforming across other major US indices. So when you trade Nasdaq, you can't use you can't trade Nasdaq and go and compare the performance of S&P 500, because there will be times where S&P 500 will be underperforming, and that's where you tend to get caught in this kind of relationship. So just to give an insight, if you are trading the US market, Nasdaq is a very different indices altogether because of the concentration in technology counters, and technology itself is a sector that everyone has been talking about. The valuations are tremendously high, and that's where, as a trader, you really need to be careful. Now, if you just look at overall, it seems to be quite rosy picture for a US market. Now, if you dive deep down in certain type of other economic indicators, especially with manufacturing numbers, despite we are showing you signs of this improving in terms of their numbers, but it's still below the 50 mark. It tells you that, generally, I think the sentiment in the manufacturing space is still not looking that robust. Now, let's look at the next few quarters. Keep in mind, interest rates are still very high right now in US market. So eventually, I think business will definitely feel the pinch of paying higher loans, interest, and whatnot. So just be on the lookout for next few quarters whether manufacturing numbers will continue to stay below the 50 mark, which usually points to you that recession is actually underway in the next quarter or so. Now, there's also another factor that we are looking at. Why the numbers has been so good is also because government incentive has been actually very, in other words, government has been very generous. They actually been supporting the market indirectly by giving a lot of hands out. And I think in certain ways, market is benefiting out of that. Construction spending by some of the key manufacturers has actually been going up because the US has initiated a lot of, COVID policies which benefited a lot of manufacturers, as well as actually the semiconductor industries. Keep in mind, Joe Biden has actually approved the CHIPS Act last year, which actually encouraged, the US consumers to shift, or US producers to shift their concentration back to the US market. So by reinvesting most of their proceeds back onto their own market. So again, all this will actually be self-fulfilling. Is actually generating more impact to the economy. So therefore, is indirectly supporting the market, because of all these policies. Now, another interesting development that is worth to take note of is that if you just look at some of the key companies that is announcing their results, you notice that some of these companies actually they perform well. You just look at Apple or Microsoft, their numbers are fantastic. They actually outbid certain forecasts or even expectation. The problem is that a lot of people when they see that expectations are much numbers came out better than expected, normally buyers will adjust positively. But we don't see that lately. In fact, I think market, whenever there's a positive earning announcement, market take it negatively. In fact, they price it down. So in other words, I think pretty much the Nasdaq valuation for some of these major companies is actually quite overstretched. So when there's any positive announcement, it's actually pretty much expected. In fact, I think market is actually really priced in. So that's why we really need to be careful. When you see this type of announcement, positive announcement having not much of an impact, it's telling you that the rally in the market may probably be coming to an end, and that's where you really need to be careful. Whether will there be any change in the trend eventually? Because keep in mind, company earnings, cannot be strong in most of every subsequent quarters. It's a very rare phenomenon. But again, as long as companies are still performing, I think that's where market is expecting. But the quick moment where companies doesn't record well in terms of their quarterly earnings, that's where we really need to be careful. So that's where as a trader going forward in the next couple of quarters or so, this is something that we really have to watch out, especially earnings from the big companies. And if those earnings are not materialized into anything positive, I think that's where you really need to be careful. Now, besides that, you just look at businesses when it comes to loan demand is also a very good indicator. Keep in mind, we tend to use economic indicators historically speaking. Everything you can look at it on a hindsight basis, it tells you a lot of picture. But whether it's good in telling you whether the current scenario will foretell based on historical basis is a very different proposition. So if you just look at historical basis, corporate loan demands is quite a good recession indicator. When it tells you that corporate demands are slumping or even plummeting, that tells you companies are not taking loans. Usually that signals you the economy is actually going to head into recession. Now, officially, US haven't gone into a recession. The economy is still showing you strong GDP growth, but loan demands is just not there. In fact, I think corporate loans are suffering. If you just look at certain other indicators like bankruptcy rates are actually going higher, that's telling you that things are not looking so good on the loan or even the bond market. So that's where you really need to balance our view when it comes to looking at the US market in totality. Now, another favorite economic indicator which a lot of people look at is the curve inversion. When you look at whether it's the shorter term treasury against the longer term treasury, the yields differential, you can clearly see that whenever the yields are inverted, which means the shorter term are priced much higher compared to longer term rates. That's where, if you just look at historical basis, it usually tells you there's a recession coming. Now, a lot of people argue that this time may be a bit different. Historical doesn't always tend to repeat itself. Again, I think we have to be very sensitive of how we see the economic numbers going forward. I think any sign of weaknesses, whether sentiments has changed, people's confidence has changed, that will be quite a clear telltale signs of where the economy is heading. So, be on the lookout, be sensitive to the economic numbers, which is crucially in the next couple of months. I think any sign of weaknesses, market will not take it quite positively. So that's where, if you're trading the US market, this is where you need to be very sensitive to as well. So this is where I'm saying, despite you're seeing strong job numbers, inflation is coming down, but you just look at how the businesses is performing when it comes to the loan side, it's actually quite dramatic in the sense that, bankruptcy rates are rising. That's one part, and downgrades are happening quite often nowadays when it comes to companies. So that's where, we need to balance our view. Despite we're seeing a lot of strong positive numbers in certain indicators, but other indicators are telling us otherwise. So, that's where you really need to pay a bit more attention. So as long as bankruptcy rates are soaring, that usually tells you that although it's a strong economy, but businesses are not doing well. Now, I think other than that, dollar and US market is very interesting relationship in the sense that if you just look at it in historical fashion, when you have a weaker dollar, normally it's actually strong for the US market. It could be because the goods are cheaper. Anything that's priced in US dollar now seems to be cheaper because the weakness of the US dollar. Now, when the US dollar starts to strengthen, that usually tells you the market is going to come down. Now, US dollar right now seems to be having a bit of strength because of the rising interest rate in the US market. But since then, I think because the inflation numbers is coming down, people are expecting interest rate probably may be, taper off or muted for a period of time. So that's where the weakness in the dollar start to persist. When that happens, usually it's a good news for the market, especially for the stock market. Now, again, these are all just historical relationship, whether it holds in the future is a different story. So as a trader, we use this as a guide for us to actually to navigate the market whenever whenever we are trading the US market per se. Now, obviously, for us to gauge the direction of the US dollar or the US dollar strength is to look at the direction of US interest rates. So as long as Federal Reserve continue to hike interest rates, normally that will signal a stronger US dollar. Now, obviously, the Federal Reserve has actually been very vocal when it comes to expectation of the interest rate going forward. So if you just look at the last FOMC meeting, Jerome Powell was saying that going forward the market will be actually looking at some key economic numbers. So if those numbers are pretty much in line, I think interest rate is actually quite any high interest rate will probably be quite muted. But keep in mind, they are still open for throughout the whole next couple of FOMC meeting throughout the year. They're still looking at possibly another hike, about 25 basis point in return. So that will probably bring about 5.5 or 5.75 on terminal rate. So that's quite quite a drastic hike compared to where we are a couple of years back, which is going to have a lot of impact. If you just look at how corporate loans has been performing, it's a very clear indication that when you have high interest rates, a lot of companies can't stay afloat because the loan interest is something that is going to eat them up. So that's where you really need to look at. Now, higher interest rate normally will entail a stronger dollar, and that may not be good for the US stock market. So that's where it's good as a gauge, but that also because of the relationship between the dollar is quite, there's a lot of variable to it. No, we can't really rely that to determine where the US market is going to go. But it's good as a gauge, as a guide for us to look at. Now, so if you just look at across sectors basis, you can clearly see consumer staples are very benefiting, especially when you have a weaker dollar. Again, I think it's because a lot of the items are priced in US dollar. So when you have a weaker dollar, it seems to look a bit cheaper, and therefore there's a demand for more US products. So therefore, it's actually generating a lot of revenue for companies, US companies, from external sales. So that's where it helps when you have a weaker dollar. When you have a stronger dollar, that will normally entails you a weaker stock market because companies will record lower earnings. Now, I'm just going to talk a little bit on China because keep in mind, US and China, they are pretty much the two largest economy in the world. Whatever happens in either market will always have an impact across the world. So on one hand, we have seen US is pretty balanced in terms of where their economy stands. Certain indicators are pointing to positive, and certain indicators are pointing to negative. China, in totality, they are quite bad. Whether it's GDP numbers, whether it's GDP growth, whether it's their capital investments, most of the economic numbers coming out from China is actually quite bad. So in a sense, I think there's always a divergence here. So therefore, you can see why the US market has actually been performing very well, because fund managers across the world, they are pulling pretty much their funds out of China and back into the US market. So that's where you can see a bit of divergence happening. Now, I'm not going to comment too much on prospect of where China economy is going to head on, but just to keep it short, China, I think they are pretty much being hit hard by property, property investment. So because of a negative growth in the property investment, it actually affected a lot of their household consumption. So that's where it's actually bringing down the whole economy. Now, if you are just looking at index itself, you can clearly see there's divergence. So blue line is the blue is pretty much representing your S&P 500, which is the US market. Your orange line is basically the Shanghai Composite Index. So you can clearly see there's actually divergence happening here. So going forward, as long as China is continuing to show you weak numbers, pretty much is quite indicative on the index itself. Now, eventually, both the market may converge. That's a given time, which that tells you that China will probably be coming out from the bottom, and US probably has reached its peak in terms of their rally, and may start coming down. So I think that's where, if you are looking at intermarkets, this is where something that's of a trade that you should be looking at. But then again, it's all given time. It may take months, it may take years, in fact. So that's where we really need to assess when you look at different markets. Now, I just want to share you on this interesting chart. This is basically comparing copper prices against the S&P 500. It's interesting in the sense that if you just look at how copper is performing, in certain ways, copper is actually leading the S&P 500. So that means when copper prices starts to come down, normally there's a time lag for the S&P 500 to start coming down, and the time lag usually take about 2 to 3 months. So you can clearly see, when we saw copper prices starts to inch higher, that time I think S&P 500 was actually on a sideways market. So I think copper in certain ways is actually quite a good leading indicator for pretty much the S&P 500 or the US market. And if you just compare with other markets around the world, copper is a very good indication. Keep in mind, copper is used a lot on industrial products. So when you have strong prices on copper prices, which indicates strong demand, that tells you there's a lot of activities going on. So that will generate a lot of economic, activities, and indirectly that will also push up the market economy. So that's, in other words, you can use copper as one of the indicators to look at if you want to gauge where the global economy is going to hit, especially for the US economy. So right now, you just look at copper prices, it's still hovering around the $4 mark. But I think you look at the short-term trend, it's still indicating to you that the uptrend is still quite intact. So as long as the uptrend is still intact, that tells you the overall economy of the world seems to be quite okay, and there's still room to grow. Now, I'm quite a fan of looking at seasonality. Now, when it comes to looking at seasonality, there's a lot of ways to look at it. You can obviously look at month-to-month comparison and just look at which particular month of the year that whether it's S&P 500 or the Dow Jones market tend to perform better. Now, when you trade commodities, let's say for example palm oil, it has a very strong seasonality effect. If you just look at over the past decade or so, when you talk about price seasonality for palm oil, towards the year end is actually a very strong performance. So that means towards your November-December period, it should be a good time for you to long palm oil futures market rather than shorting the palm oil futures market, because based on seasonal trend, whether it's lower production, high exports, normally it's positive prices. Now, if you just if you just draw the same comparison for the S&P 500, and you just do it over the decades or so, you can clearly see there's a couple of months where the index tend not to perform well, and there's a couple of periods where the index tend to perform relatively quite okay. So if you just look at it, January usually is not a good month for the S&P 500 for the past decade or so. And keep in mind, around middle of the year, especially going into July, August, and September period, that's where index tend to be a bit more volatile. So that's where we are heading into the third quarter of the year. Usually it's going to be a very volatile period, and the index tend to perform relatively quite weak. Now, if you just look at towards the year end, especially November, December period, whether you can attribute to a December effect or not, but it seems that the index performed relatively better. So that's where, if you are looking at seasonality, you can take a guide. That means you are now entering into a weaker period in the index market. Preferably, you should be looking at opportunities for you to short rather than long the market. So that's how we can use the seasonality effect as a gauge on how we position our trades going forward. Now, just to share with you on a technicality aspect, that one thing about trading style is there's various trading styles outside, and I would say that you must find a trading style that suits your personality at best. So if you are someone that prefers swing trading, just looking at trends, then use a trend trading strategy. Now, if you are someone that's looking at mean reversion, looking at a particular range and trade that within that market range, then you have to use a mean reversion strategy. So be accustomed to what type of trading style that you want, and it's actually more to what type of profile of a trader you are, and from there you'll probably gauge on what kind of trading strategy that's beneficial for you. So for myself is, as a trader, I'm more to a trend trader. So I'm looking at trends in particular. There's a lot of ways to look at market trends. Most of it is usually by verbally. Just look at it visually, whether the charts are looking at higher highs and higher lows. that usually tells you that the market is generally on an uptrend. If it's a lower high, lower low set, generally tells you the market is on a downtrend. So visually, you can actually look at the chart and determine the trend. Now, to make things easier, you can also use moving averages, which is also type of trend indicator. We simplify or pointing to you the averages of the price by lines. So in other words, it's actually making it easier for you to identify whether the trend is up or down. So what I have here is that we have double lines, EMA lines, exponential moving average. One is using a 50 period, another one is 200 period. So as long as the shorter term, which is a 50 period EMA, is trading above the 200 period EMA, it tells you generally the market's on an uptrend. And if the candles are trading above these two lines, it tells you market is pretty much on a strong rally. Again, you can use many ways to determine a trend, but for myself, I think using moving averages is a very simplistic view to see the trend on the market. Now, there is a lot of ways for you to trade a particular trend market. The first thing is always to establish a trend on the market. So, example, if the trend on the market is uptrend, find position for you to ride the uptrend on the market. There is always a mistake that very common for new traders is that when they see a particular trend, let's say it's an uptrend rally, they tend to try to find or to locate the eventual turning of a particular trend. Now, the business of going against the trend is never a good business to be in. Keep in mind, if it's an uptrend rally, try to find positions for it to long rather than short, because eventually I think a trend can persist and can extend to long period of time. So if you're trying to find the turning point of a particular trend, it's not an easy proposition. So that I think therefore, if a trend is telling you this is an uptrend market, be in a position for you to find long positions to be in the market. Now, I just want to share you on using this DMI directional movement indicator, which is I think available on most charting platform. What's interesting to take note of is that there's three major indicators in this DMI. One is called positive DI, which is usually denoted as the positive blue line, and the negative DI, which is usually denoted as the orange red line. Obviously, these color lines you can change it accordingly. But what this tells you is that whenever you see a negative DI line going above the positive DI, it's actually a bearish move in the market. So that means the downtrend rally is actually quite imminent. Now, there's also a third line called the ADX line, which is the red line. Now, ADX usually it's just a numerical value. So anything above 20 in numerical value, it tells you there's a trend in place. So right now you can see the circle point here. You can clearly see that the negative DI was actually very strong. It crosses above the positive DI. It tells you generally the market is heading for a downtrend, and it's actually the trend is quite persistent because the ADX value or the ADX line is actually increasing. So when you see that, that means the downtrend rally is in place. So in this type of rally in place, downtrend, find a position for you to short rather than thinking a position for you to long. So I think DMI is a very good trend indicator, and ADX, which is part of the DMI indicator, is a very good measurement of telling you whether the market is trending or not. So I think that's a very good indicator for you to use whenever you look at trend. Now, obviously, we can also use moving averages. So in what I have here is incorporating two types of moving averages. So on top of using DMI indicator as a trend indicator, I also utilizes moving averages as part of also a trend indicator basis. So simple. I think one way is look at crossovers. Crossovers are basically denoted as if you have two lines, one will be a shorter term and another one will be a longer term. So what I use here is basically looking at 9-period EMA with a 20-period EMA, and with Heikin-Ashi candles. Now, Heikin-Ashi I'll explain to you later part, but just bear with me. So whenever you have crossovers in moving averages, it's simple. If the shorter term is crossing below the longer term, generally is a bearish scenario. And if you can confirm with that with the DMI, I think that's a very good signal to take. So eventually, I think these are all trend indicators that you can use whenever you are trading based on trend basis. So now this is another classic example of using DMI. You can clearly see here that the trend is actually the positive DI actually crosses for the first time above the negative DI, which tells you the market probably is going to hit into the upper trend. And if you just look at chart pattern, if you just draw a resistance, no, clearly I think at this point of mark, the candles are breaking above the resistance. So if as long as the next candle is above the resistance line, it's actually technically a breakout. So again, you can use this as ways for you to navigate a trendy market. Now, I also uses ATR, which is average true range. Now, ATR, it's not part of the trend indicator. ATR is basically to determine the entry and exit level. Now, in any trading plan, I always emphasize this, especially for new traders outside. There is always a misconception that, I always want to find entry, but I never think of how the way to exit. Now, in any trading strategy, we must have a plan to exit. Whether it's exiting at a profit or exiting as a loss, regardless, because if you don't have a plan for it to exit, that usually signifying you are taking too much of a risk. Now, there's a lot of ways to put stop losses, whether you're putting a numerical value or whether you're putting on the chart pattern, that's the resistance or support level. There's many ways, but what I'm going to share with you today is this basically looking or using the ATR value as a way to measure your risk and reward. So how to do it? Basically, it's very simple. This is a micro E-mini Nasdaq. So you can clearly see that this particular candle shows you a breakout. And just look at DMI indicator, the positive DI starts to go higher. That means looks like it's going to be a bullish trend in the Nasdaq market. Now, the value of the ATR is pretty much 40 ticks. A simple way to do it is if the ATR value is 40 ticks, you enter a long position at 15,048. If you just book on a reward to risk ratio 2:1, that means you're looking at a reward of 80 ticks and a risk of 40 ticks. As simple as that. Now, keep in mind, the ATR value can increase. So ATR is basically average true range. I'm not going to go too much on the maths of it. You can obviously Google. What is basically measured is basically the volatility of the particular day. So if, example, if a Nasdaq markets become very volatile, especially during FOMC meeting days, ATR can go up to as high as 50 or even 100 ticks on a daily basis. So that's where you need to adjust your stop loss level accordingly. Now, like I said, there's a lot of ways for you to manage your stop loss, but having an ATR or base your exit level based on ATR value, it gives you a bit of room to maneuver, because if you set too tight of a stop loss, there's always occurrences whereby market tends to gyrate and it always hit your stop losses. Indirectly, you are wasting a lot of commission and you're losing a lot of profit potential. So that's where ATR can come in handy, and you need to be prepared. If the market gets a bit more volatile, technically speaking, your risk level will also be expanded. So that's where we really need to be aware of and be taking note of as well. So in this case, the ATR is 40 ticks. So your profit target you're looking at is 80 ticks. So that means you're taking an entry long position at 15,048. You're looking at 15,128 as your profit level, and your stop loss is at 1,500. So 15,000. So that's where normally you'll be using ATR as a value to gauge your entry and exit level. So if you just look at the next subsequent candles, it looks like the market did hit up the trend channel. Keep in mind, as long as ADX value is increasing, that means the uptrend rally is in place. There's a trend rally, and as long as a positive DI is above the negative DI, it's telling you that the market is still bullish. So that's where if you're holding into the long position, you can use that. But be disciplined. If your profit target has already achieved, you should be out of market. And look for the next set of opportunity to enter the market again. So now just to share you, this is basically the ATR on a daily basis on a micro E-mini Nasdaq. You can clearly see, I think on a daily basis, Nasdaq move between the range of 300 to 500 ticks, which is quite substantial. Again, markets, if in a highly volatile market like Nasdaq, you need to be prepared, because the ATR value is high. That means your reward to risk level is also going to be quite significant. Now, if you want a smaller range market, you can obviously look at S&P 500 or even the M2K, the Russell 2000. Those ATR values is actually quite small on a daily basis. Again, these are all risk preferential. It is different across different traders. It's all ultimately which markets you're most comfortable with, and you should trade those markets that you're feeling very comfortable with as well. So just to share with you, last bit I'm just going to talk about Heiken Ashi, which I think is a very useful, type of candlesticks that you can use outside to determine trend. Now, I'm just going to ask you this question, the audience here that's listening tonight. If I'm just going to show you these two particular chart A and chart B, and if I ask you to trade based on a trend basis, which particular chart will you trade? Is it chart A or chart B? Or in other words, which particular chart do you think is a better chart to trade based on trend? Maybe I just want to get some response from audience. You can just type your answers in the chat box, and I'll just have a look at it. Yeah, thank you for the response. So you can clearly see, I think chart B seems to be a better chart. Now, keep in mind, both these charts are the same. Same product, same time frame. The only difference is that chart A is your normal Japanese candlesticks. The chart B is your Heiken Ashi. So you can clearly see Heiken Ashi is a derivation of a Japanese candlesticks, but it tells you the trend. It indicates to you the trend in a clearer fashion. Now, the only downside if you compare chart A and chart B, you notice that chart A there's gaps. So if you are someone that's looking at charts and you trade based on gap trading, if you use Heiken Ashi, it doesn't work, because in Heiken Ashi it doesn't look at you don't have gaps. It's the gaps represented by the candle. So that's where it can get a bit more confusing. But having said that, I think Heiken Ashi is a very good tool and indicator, especially for candles, to look at trend of a particular time. Now, the reason why I chose Heiken Ashi is simple, because if you just look at Japan's candlesticks, there's so many combinations. If you just read Steve Nielsen's book, there's 100 over combinations. Whether it's 3 black crow, 3 white soldier, or whatnot, there's so many combinations. So it gets very tedious. It takes a lot of effort to really master Japanese candlesticks, going through so many type of charts. Now, Heiken Ashi simplified in certain ways. They simplify the pattern into 3 distinct patterns. As long as the candle is green, the market is bullish. As long as the candle is red, the market is bearish. So the wider the body of the candle is, the stronger the momentum, the stronger the trend is. And if the body of the candle is very small, more like a dodgy type of candles, that tells you the uptrend or downtrend rally is probably coming to an end. The market is going sideways, or there's no direction in the market. So it's as simple as that. By looking at the color of the candle, the body of the candle, and the tail of the candle, you probably can see where the trend of the market is. So just to give you a comparison, Japan's candlesticks, there's 100 over combinations. Heiken Ashi is only 3 major forms. And keep in mind, Heiken Ashi, the way they derive the Heiken Ashi candles is actually mathematical. So if you are someone that's doing programming, you do algo trading and whatnot, Heiken Ashi is quite suitable, because it helps you in certain ways to to quantify it. So in a way, it's actually very quantitative. Japanese candlesticks are very subjective. It depends on how you see it, the configuration, how you see the pattern. So that's where it gets a bit more subjective in nature. Heiken Ashi is more of a trend following indicator. Japanese candlesticks are mainly used for reversal patterns. Whether it's spot a doji or whether it's spot a morning star or whatnot, it's more towards a reversal pattern. Heiken Ashi is pretty much based on color. As long as it's green bodied candle, it tells you the market is actually generally bullish. Red candles are telling you the market bearish. Japan's candlesticks is more to the pattern itself, and again, there's so many 100 over combinations that you can look at. It gets very messy and confusing. So just to share with you the dynamics of it, this is basically the Heiken Ashi dynamics. You can clearly see, as long as the body of the candle is a white green body candle, that tells you generally the market's on an uptrend. And when those body candles starts to get smaller, or it becomes a single body, or there's no body at all, that's where it tells you that the uptrend is slightly coming to an end. In fact, the trend might change. And if the next candle is a strong red candle, that tells you it's going to be a bearish move. Now, you can obviously use moving averages again, to highlight clearer as to where the turning is. So one of the ways is I always use is looking at 9 period and a 10 period EMA, and you just plug it together with Heiken Ashi. You get quite a good combination of using a trading strategy. Now, obviously, you can also use the DMI. Whether you are using the EMA or DMI, both of these indicators are quite in line. So using either one is good enough. But if you want to use both, it is also quite a good sufficient. But keep in mind, there's always a period where DMI indicators tells you it's a strong bullish signal now, but your moving averages has not crossed yet. So that's where the confusion can come in. And trading principle is always this: keep it simple. When you have too many indicators, it tends to complicate matters for you to make decision. So I would say either one. You can always, certain points you can use DMI together with Heiken Ashi is a good combination. But if you want just to use moving averages with Heiken Ashi, is also fair. Now, last but not least, I think with every journey, whether it comes to trading, the last bit is always about tracking your progress. As a trader, I think for many years in the market now, is when I first start this journey, it's always very, very tedious to journal your progress. To do it on a daily basis is not easy. It requires a lot of discipline. But along the years, when I actually look at the importance of why tracking your progress is important, finally you actually understand. Because the more you understand the nature of your trading, the more you understand the nature of yourself, and that's where it can actually gives you a bit more insights onto how your trading strategy persists. So I would say journaling is the last bit, and it's the most important bit of any trader's journey. And any observation that you see in the market, we should put it on note and keep it for future observation, because that's the way for us to improve. If we don't journal, we won't know our progress. So I'm just going to share with you on, because since I'm talking about a lot on US market today, I'm just going to touch about the contract specs which I mentioned earlier on. So CME has a comprehensive suite of products for you to look at when it comes to US market indices. Like I mentioned, the micro E-mini contracts are very exciting because for the first time, the margins are very acceptable, and it's very palatable for someone that's new to the market. Those days, if you want to trade, you want to gain exposure in E-mini contracts, those contracts are huge. It's actually cater more to the fund managers and whatnot. So nowadays, I think with the micro contracts, it makes it easier, for traders who don't have much capital but want to gain exposure in US market. I think micro contracts is a way to go. In fact, it's actually 1/10 of the size of the E-mini. So I think the most common one is micro E-mini S&P, which is short for MES, micro E-mini Nasdaq, MNQ, and micro E-mini Russell 2000, and also the micro E-mini Dow. I think these 4 major micro E-mini indices are, if you want to look at US market, these are the contracts that you should look at. Now, obviously, there's concern on liquidity because these contracts are new. They probably launched about 2 years already. You can clearly see, I think, you talk about volume and liquidity, there's no issue at all. Volume on a daily basis is in, you look at MES, the micro S&P, E-mini S&P, you can clearly see the volume itself on a daily basis almost close to 1 million contract, with an open interest of almost 200,000 to 300,000 contracts, which is very liquid. So there's no issue of bid and ask that's not tight, or there's slippage. I think there's no issue on that. And open interests are very healthy. It tells you there's a lot of interest in the market. That is trading the market space. So I'm just going to end here with a quote. I'm not sure whether any of the audience know about this famous trader called Alexander Elder. You can obviously go and check him out. He always mentioned this, which I find it very useful if you are someone that is trading the market. The goal of a successful trader is to make the best trades, which is very true. It's more to the process rather than the result. And if you get that right, money will always be secondary. So always the main thing is to get a process right, whether it's the discipline that you need, whether it's a mental frame that you require, whether it's a particular thinking or framework that you need to do before you engage the market. I think those are necessary. Those are even more important. And ultimately, if you get that right, money will always be your P&L will always be reflective of your work. So with that, I'm just going to end here.